What's the first company that you're looking at?
The first one is Halliburton. Stock's been in a really nice uptrend all year, so it hasn't just been the spike in oil prices from a few months ago that have been responsible for the stock's gains. It's just in a nice steady uptrend, and I love stocks that are just kind of slowly climbing up and to the right. That's kind of a very sustainable move versus something that just spikes higher and that you hope will continue. They have increased activities outside the Middle East, so they're not reliant on the Middle East. They do a lot of work in the United States and offshore of the United States. So that's really important because you certainly want to diversify your risk and not be super concentrated in the Middle East. They are involved with fracking in the US, and we know that the president and the industry and Americans want oil and gas coming out of the ground in America, especially after what we just saw in the Strait of Hormuz. It's more important than ever that we're self-reliant in our oil supply. So now, to be clear, they provide the equipment, the personnel for the oil drillers. So they are not the Exxon Mobils that are pulling the oil out of the ground. They're the ones providing the equipment to do it. So as long as all the big oil drillers are doing that, they have to get their equipment from somewhere, and they get it from companies like Halliburton. Their earnings are projected to grow 23% this year to $2.91 a share, and then another 15% in 2028. So this is very much an earnings grower, and they're only trading at 16 times earnings. And if you think about it, if this traded just up to 20 times earnings, which is not an exorbitant value, and if they earned, let's say, just $3 a share, which is less than the consensus estimate for 2028, then we're talking about a $60 stock. So it would be a really nice move. It's not a double or a triple in a couple of years, but it would be a pretty impressive move for a big company over the next 2 years.